Welcome to The Deep Dive, your go-to show for unraveling complex topics, transforming dense research into clear insights, and essentially giving you a shortcut to truly being well-informed. Today, we're tackling a question many people ponder about auditing. How on earth can auditors claim to verify billions of dollars in transactions when they can't possibly check every single one? The answer lies in a sophisticated blend of art and science: audit sampling. We're diving into sampling, part 2 today, using your excellent sources to show you precisely how auditors strategically pick just the right slices of data to understand the whole financial pie, ensuring everything is as accurate as it needs to be.
Indeed. This deep dive will illuminate the precise statistical methods auditors leverage to estimate numerical measurements, thoroughly assess financial health, and ultimately ensure the accuracy of monetary amounts.
Okay.
We'll be revealing the precision behind those critical numbers, exploring not just what auditors do, but also the fundamental why behind these essential techniques. It's a crucial aspect of how financial trust is built.
Okay, let's unpack this. When we talk about variable sampling in auditing, what exactly is it and what's its main goal? It sounds like we're getting into the nitty-gritty of the numbers themselves, the actual dollar figures.
You're absolutely right. Variable sampling is a truly powerful statistical method that auditors use.
Wow.
Its primary design is to get a reliable estimate of numerical measurements within a large group of data, what we call a population.
Right, the whole group.
Exactly. Think of it in terms of actual dollar values, for instance. Trying to get a reliable figure for a company's total accounts receivable balance, which of course is a direct monetary amount. Its main role is in what auditors refer to as substantive testing. This means it's used to gather direct persuasive evidence about whether those monetary amounts reported in financial statements are reasonable, accurate, and free from material misstatement.
So it's fundamentally about checking the actual money figures, the dollar values, not just the underlying processes or procedures. That makes sense.
Exactly.
But it sounds like a massive leap to go from auditing a small slice of accounts to confidently stating the true value of an entire population. How do auditors bridge that gap? What's the magic behind estimating that overall true value?
Precisely. It's fundamentally about the money, the actual financial figures. To estimate that true value, the auditor first computes what's called a point estimate.
A point estimate.
Yes, it's their single best guess, based on the sample data, for what the true value of the population is. But because it's based on a sample, there's always an inherent degree of uncertainty.
Sure, yeah.
So to account for that, they then construct a precision interval around that point estimate.
A precision interval. For our listener, can you give us a quick mental image for that? Like, what does that actually mean?
Absolutely. Imagine your point estimate is a bullseye. The precision interval is kind of like the ring around it, the statistical confidence zone.
Yeah.
It tells you we're, say, 95% sure the real number for this entire population is somewhere within this specific range. It's all about quantifying that uncertainty and providing a well-defined, practical boundary for their best guess. It gives practical meaning to their estimate, you see.
Got it. Before an auditor even begins this process, it sounds like there's a lot of upfront strategy. I'm genuinely fascinated by how auditors make these critical upfront decisions. What are some of the non-negotiable considerations they have to factor in before even selecting a single item for a sample?
You've hit on a critical point.
Yeah.
Upfront strategy is paramount, and several factors are critically important when planning a sample for a substantive test of details.
Okay.
First, and perhaps most fundamentally, the auditor must ensure there's a clear relationship of the sample to the relevant audit objective.
Right.
This means that whatever items they decide to sample must directly help them achieve the specific goal of that audit test. For example, if the audit objective is to confirm that accounts receivable actually exist and are legitimate, then the sample items selected must be directly relevant to confirming that specific assertion. It wouldn't make sense to sample something unrelated to your goal, obviously.
Very sense.
Second, they must carefully consider their preliminary estimates of materiality levels. This is where it gets truly interesting.
Okay.
Within this context, a key concept is tolerable misstatement. This is, quite literally, the maximum monetary misstatement, the largest error in dollar terms that the auditor is willing to accept in a specific account balance or a class of transactions without concluding that the financial statements overall are materially misstated.
So it's like their error threshold for this specific test.
Exactly. It's their practical threshold for what constitutes a significant error that they're willing to tolerate for this specific test. Now, here's a truly surprising twist on materiality that often catches people off guard. Tolerable misstatement is the practical, on-the-ground application of performance materiality to a particular sampling procedure.
Okay, performance materiality. That's
Yeah.
usually set for the whole financial statement, right?
Correct. Performance materiality is generally said for the financial statements as a whole, or perhaps significant classes of transactions. But often, the tolerable misstatement for a specific sampling procedure is even smaller than the overall performance materiality.
Really? Smaller? Why?
Yes, the insight. Auditors are actually building a tighter safety net for each individual piece of the audit, ensuring that even small segments meet an incredibly high bar.
Okay.
This doesn't just reduce the risk in that one area, it compounds to strengthen confidence in the financial statements as a whole.
Yeah.
It's about being extra cautious where it counts.
Got it. That makes sense.
Third, auditors must establish the allowable risk of incorrect acceptance. Think of it like this. An auditor's job is to manage risk.
Right.
And to do that, they rely on something called the audit risk model. It's essentially their strategic blueprint, a fundamental framework that helps them decide how much to test, when to test it, and what kind of tests to do. This specific risk, the risk of incorrect acceptance, is crucial. It's the risk that the auditor might, based on their sample results, incorrectly conclude that a financial statement amount is fairly stated when, in reality, it contains a material misstatement.
So they accept it, but it's actually wrong.
Precisely. It raises an important question. How comfortable are you, as the auditor, with the possibility of being wrong in your conclusion about a balance? A lower allowable risk of incorrect acceptance means the auditor needs more persuasive evidence, which often translates directly to a larger sample size.
So this assessed risk you mentioned as a factor, how does that play into it? Are we talking about combining different types of risk here?
That's right. This assessed risk is where auditors blend two crucial ideas. Inherent risk, which is how likely something is to go wrong purely by its nature, like, cash always being riskier to handle than office supplies.
Sure.
And control risk, which is the chance that the company's own internal safeguards won't prevent or detect an error. So it's about evaluating both the natural pitfalls of an account and the strength of the existing safety nets, and then using that combined assessment to fine-tune the sampling approach.
And the last planning factor.
Finally, auditors must understand the characteristics of the population they are sampling from. This includes factors like its total size, the variability of the individual items within it, how much they differ from each other.
Right, the spread.
Exactly, the spread and its overall structure. Knowing these characteristics is vital because it helps the auditor determine the most appropriate and efficient sampling approach, whether that's classical variables, sampling, PPS sampling, or something else. Without this understanding, the sample might not be truly representative, compromising the entire audit's effectiveness.
Got it. So with all that meticulous planning done, how does an auditor actually pick the items to look at? Is it just random, or is there a truly strategic element to this selection process?
Oh, it's very strategic. Professional judgment is absolutely key.
Yeah.
Auditors don't just blindly pick items from a list. There are certain items within a population that might be so inherently significant that a potential misstatement in just one of them could, by itself, individually exceed the tolerable misstatement we just discussed.
Ah, the really big ones.
Exactly. The really big ones, or maybe highly unusual ones. For these extremely significant items, the auditor examines all of them. That's a 100% examination.
100%.
Yes. These specific items aren't even considered part of the statistical sample because they're universally checked outside of the sampling methodology simply due to their high individual risk.
So if a single error in a large or critical account could be a really big problem, they just go ahead and check everything in that account or category. That makes perfect sense. You don't want to leave anything to chance with those high-impact items.
Exactly. It's about meticulously targeting the highest risks and ensuring full coverage where the potential for material misstatement is greatest.
And what about the rest of the items, the ones not individually examined because they don't pose that same individual high risk? How do auditors make that process of selecting a representative sample more efficient and focused?
This is precisely where stratification comes in, and it's a brilliant technique for efficiency and effectiveness. Items that are subject to sampling, meaning that they aren't the individually significant ones we just discussed, can be separated into relatively homogeneous or, similar groups.
Okay, grouping similar things together.
Right. Think of it as dividing a diverse population into smaller, more uniform subpopulations, Each of these newly formed groups is then treated as a completely separate population for sampling purposes.
What's the core benefit of doing that? Why go through the trouble of dividing everything up?
Stratification generally leads to a significantly reduced sample size overall.
Ah, efficiency.
Exactly. It makes the audit far more efficient in terms of time and resources without sacrificing the effectiveness or reliability of the audit conclusions. It's particularly useful and powerful when a population has widely varying recorded amounts.
Like lots of small transactions and a few huge ones.
Precisely. You don't want a few very large items skewing your sample results by dominating the average, nor do you want tiny, insignificant items getting disproportionate attention compared to their risk. By grouping similar items, the variability within each group is reduced, which in turn allows for a smaller, yet still statistically valid, sample to be drawn from each stratum.
Can you give us an example?
Sure. Let's use a concrete example to really illustrate this. Imagine you have a total of 1,000 accounts in an accounts receivable balance. If you stratify them, you might decide, based on your professional judgment, to examine the 100 largest accounts individually.
The 100% check again.
Right. These 100 items would be subjected to 100% examination, as we discussed earlier, meaning they are not considered part of the statistical sample. Then, sampling techniques would only be applied to the remaining 900 items.
Okay.
In this specific case, your population size for the statistical sampling application would effectively be 900, not the original 1,000. It's a very clever way of focusing your efforts and audit resources precisely where they're most needed and where the sampling methodology will be most effective.
So, after carefully planning, selecting the sample, and auditing those specific items, what happens next? How do auditors extrapolate from looking at a relatively small group to understanding the financial health of the entire population?
Right. Once the sampling procedures are thoroughly completed, meaning the auditor has examined each item in the sample and determined its correct audited value, the next critical step is to project the misstatement results found within that sample back to the entire population from which it was drawn.
Projecting, like scaling it up. Essentially, yes. This projection gives them an estimated total misstatement for the whole account balance or class of transactions. It's their best statistical approximation of the total dollar error present in the full set of data.
And then, how do they decide if that projected misstatement is actually acceptable? Is it just the simple comparison, like, is the projected error below our tolerable misstatement? Or is there more to it? It sounds like there's always a margin of error inherent in sampling.
It's definitely more nuanced than a simple, direct comparison. While that comparison is central, it's not the final step.
Okay.
If the total projected misstatement that the auditor has calculated is less than the tolerable misstatement for that specific account balance, the auditor still has to carefully consider a crucial risk. What if, despite this favorable sample result, the true monetary misstatement for the entire population actually exceeds the tolerable amount?
The sample was just lucky. Exactly. There's always that inherent sampling risk that the sample just happened to look better than the overall population. Let's consider a practical scenario to make this concrete. Assume you're auditing an account balance with a recorded value of $1 million, and the tolerable misstatement you set for this account is $50,000.
Okay. $1 million account, $50,000.
Right. Now let's look at two possibilities for the projected misstatement from your sample. First, if the total projected misstatement from your sample is, say, $10,000.
Way below the $50K.
Right. $10,000 is significantly less than the $50,000 tolerable misstatement. In this situation, the auditor would likely feel reasonably assured that the sampling risk, that is, the risk of being wrong due to the sample not being perfectly representative, is acceptably low. They would conclude that the true misstatement in the population probably doesn't exceed $50,000. The buffer is large enough to provide comfort.
Okay, that makes sense. But what if it's closer?
Good question. What if the total projected misstatement comes out much closer to the tolerable misstatement, let's say $45,000?
Still technically under the $50K limit.
True, technically under. But the auditor might conclude there's an unacceptably high risk that the actual error in the population does exceed the tolerable misstatement. Even though $45,000 is under $50,000, the margin for error, or for sampling risk to push it over the edge, is simply too small to be comfortable.
So it's too close for comfort.
Exactly. In such a case, the auditor would likely need to perform additional procedures or perhaps request the client make adjustments.
So it's not just about hitting a specific numerical threshold, but truly understanding the level of confidence or lack thereof around that threshold. It's about the precision of their estimate. Does an auditor ever just get a gut feeling that a number is off,
Mm.
even if the stats are just barely within limits?
Precisely. This is where professional judgment truly comes into play. The numbers provide the statistical basis, but auditors must apply their extensive expertise, their understanding of the client's business, internal controls, and the overall audit context in making these critical evaluations
Mm.
and determining the ultimate significance of the projected misstatement. And yes, absolutely, that gut feeling often prompts them to dig deeper, to ask more questions, or perform additional procedures, even when the initial statistical results are borderline. It's the art complementing the science.
Yeah, that experience factor.
Absolutely. Ultimately, the projected misstatement results from all audit sampling applications, combined with any known misstatements that were found through non-sampling methods, for example, if they did that 100% check on certain large items and found errors there.
Right, the ones pulled out earlier.
Exactly. This comprehensive overall picture of misstatements, along with all other audit evidence gathered during the engagement, helps the auditor evaluate whether the financial statements, when looked at as a whole, might be materially misstated. It's a holistic assessment. No single test result stands in isolation.
Got it. We've drilled down on how auditors estimate dollar values using classical variable sampling. But what if we told you there's another powerful approach that doesn't just estimate, but actually selects items based on their dollar value, prioritizing the biggest ones automatically? Let's switch gears and explore the different flavors of classical variable sampling an auditor can choose from. Are there different tools for different jobs within this category?
Yes, there certainly are. While the overall purpose of variable sampling remains the same, to estimate a numerical measurement, there are three commonly used classical variable sampling plans that auditors employ.
Three main types.
Yes. These methods are specifically designed to measure sampling risk by looking at the variation that's the spread or dispersion of the underlying characteristic being measured, such as a dollar amount. Understanding this variability is key to determining sample size and evaluating results.
Okay, what's the first one?
The first of these is mean per unit MPU estimation. This plan is quite straightforward conceptually. It uses the average value of the items that were found in the sample to estimate the true total value of the entire population.
So if the average value of, say, an accounts receivable balance in my sample is X dollars, I would then multiply that average by the total number of items in the population, and that would be my estimate for the whole population. Is it that simple?
Exactly. The formula is simply estimate equals average sample value X, number of items in population. An interesting point about MPU, and one that distinguishes it from some other methods, is that it doesn't actually require the auditor to know the population's book value, the client's recorded value up front, in order to make its estimate of the true population value.
Oh, that's interesting. Doesn't need the starting number.
Right. This can be an advantage in certain situations where the recorded value might be unreliable or simply unavailable for the entire population.
Okay. What's the second method?
Next, we have ratio estimation. This method takes a slightly different approach. It uses the ratio of the audited or correct values of the sampled items to their book values, their recorded values.
Okay, the ratio between audited and recorded.
Yes. And it uses that ratio to project the true population value. So it's looking at the relationship between what the client recorded and what the auditor found to be correct, and then applying that relationship to the entire population's recorded value.
When would an auditor typically choose this method over MPU? What kind of situations make ratio estimation shine?
Ratio estimation is considered a highly efficient technique, especially when the audited amounts are roughly proportional to the client's original book amounts.
Proportional, meaning if the error is usually a certain percentage.
Exactly. If the errors or misstatements in the population tend to be a consistent percentage of the book value, for example, if items that are recorded at $1,000 tend to be off by $50, and items recorded at $10,000 tend to be off by $500, maintaining that 5% error rate, then this method is very effective. It leverages that stable proportional relationship to arrive at a precise estimate.
Got it. And the third classical method?
The third method is difference estimation. Instead of a ratio, this plan uses the average difference in dollar amounts between the audited values and the book values of the sampled items.
So the average dollar error.
Right. It calculates this average dollar difference and then projects that average difference across the entire population to arrive at the actual population value. So it's focusing on the amount of the error rather than a proportional relationship.
And when is this one preferred over ratio estimation? They both seem to involve calculating differences or ratios in some way.
Good point. Difference estimation is primarily used when the differences or errors are not nearly proportional to the book values. For instance, if errors tend to be a relatively fixed dollar amount regardless of the item size.
Like maybe every mistake is around $100, big account or small.
Exactly. If errors tend to be a fixed dollar amount like that, regardless of the item size, then difference estimation would be more appropriate and more efficient than ratio estimation. It accounts for errors that don't scale directly with the recorded amount.
So how do these three classical variables sampling plans compare in practice, and how does an auditor decide which one is the right tool for the job? It sounds like there's a distinct purpose for each.
There absolutely is a distinct purpose. Here's the breakdown for choosing the right tool. Firstly, mean per unit, MPU, is very sensitive to the variability within the population. If the dollar amounts of the individual items in the population vary wildly.
A big range of values.
Yes. Then MPU can require a very large sample size to achieve the desired precision. Because of this inherent sensitivity, auditors typically stratify, meaning they divide the population into similar, less variable groups when using MPU.
We talked about stratification earlier.
Right. The main purpose of this stratification when using MPU is precisely to reduce the required sample size, making it a more practical and cost-effective method.
Okay. What about the other two?
Secondly, the ratio and difference methods generally require smaller sample sizes compared to MPU to achieve the same level of precision. This makes them more efficient, which is always good.
Definitely.
However, they are only truly effective and efficient when the auditor anticipates a significant number of both overstatements and understatements within the population.
Both types of errors.
Yes. If errors are predominantly in only one direction, for example, only overstatements and very few understatements, then these methods might not be as efficient or as accurate in reflecting the true population value. What's fascinating here is that while all three methods, MPU, ratio, and difference, use the same fundamental sample size and evaluation formulas, the actual sample size they require for a given level of assurance can vary quite a bit.
Why is that? Same formulas, different sizes.
It's because the standard deviations, which, as we discussed, are measures of variability or spread of the populations, are calculated differently for each of the three methods.
Ah, the variability calculation differs.
Precisely. Each method's unique approach to measuring and accounting for risk and variability influences the size of the sample needed to achieve a statistically valid conclusion. This highlights the statistical depth embedded in these audit techniques.
This is where it gets really interesting. Let's put all these pieces together. Can you walk us through the actual steps an auditor takes when conducting a variable sampling application? From start to finish, what does that systematic process look like for our listener?
Of course, it's a very systematic and disciplined process designed to ensure thoroughness and statistical validity. The first step is always to 1. Define the objective of the test. This needs to be crystal clear from the outset. What exactly are we trying to achieve with this specific sampling application? For instance, the auditor might want to estimate the total monetary value of an account balance, like the client's accounts receivable. Knowing the objective guides all subsequent steps.
Step 1, know your goal. Got it.
Exactly. Next, the auditor must, 2, identify the population. This population must be appropriate and relevant for the defined audit objective. Crucially, any individually significant items.
The ones we talked about before.
Right. Those items for which a potential error, if it existed, could individually exceed the auditor's tolerable misstatement should be identified up front. These items are typically then set aside for 100% examination, as we discussed, and are excluded from the population that will be statistically sampled.
So pull out the big fish first.
You got it. Imagine a scenario where a client has 5,000 individual accounts in their accounts receivable, with a total recorded book value of $4,500,000. If some of these accounts represent very large potential exposures to error, they would be fully examined first before any sampling begins of the remaining accounts.
Makes sense. Step 3.
Step 3 is to 3. Define the sampling unit. What precisely are we going to count or examine? The auditor needs to consider the completeness of the population when defining this unit. In our accounts receivable example, each of those 5,000 individual accounts would likely be defined as a sampling unit. This means that if an account is selected for the sample, the auditor will examine that entire account.
Okay, define what one item means.
Exactly. Step 4 is a crucial quantitative one. 4. Determine the sample size. This is where statistical rigor comes in. The auditor uses specific parameters, often in conjunction with statistical tables or complex formulas, to calculate the appropriate sample size.
And these parameters are?
They include tolerable misstatement. As we discussed, the maximum error the auditor is willing to accept in that specific account. Expected misstatement. This is the auditor's prediction or best guess about the size and frequency of misstatements they anticipate finding.
Like how many errors do they think are already there?
Right. If they expect more errors, they'll need a larger sample to capture them. Acceptable level of risk. This encompasses various risks, including the overall audit risk, the specific risk of incorrect acceptance.
Accepting when it's wrong.
Yes, and the risk of incorrect rejection.
Rejecting when it's actually right.
Correct.
Yep.
Characteristics of the population. This is a vital statistical input, particularly an estimate of the standard deviation or variability of the population. More variable means larger sample generally. And finally, assess risk. This incorporates the assessed risk of material misstatement, inherent risk plus control risk, and the assessed risk for other related tests.
That's a lot of factors. For our listener, what's the simple takeaway about how these factors push the sample size up or down?
Good question. It's important to understand the relationships here. The required sample size will increase if expected misstatement, the standard deviation, population variability, or the assessed level of overall audit risk increase.
So more expected error, more variability, more risk overall, bigger sample.
Exactly. Think of it as more uncertainty or risk means more evidence is needed, so a bigger sample. Conversely, sample size will decrease if tolerable misstatement or the acceptable level of risk of incorrect acceptance increase.
So if you can tolerate more error or accept more risk of being wrong, you need a smaller sample.
Precisely. These are inverse relationships. It highlights the careful balance auditors must strike between efficiency and assurance.
Okay, that clarifies it. What's step 5?
The fifth step is a 5. Select the sample. The sample items must be chosen in a way that ensures they are representative of the entire population. This often means using random sampling techniques to avoid bias, like simple random sampling or systematic random sampling.
Got to be random or representative anyway.
Right. In our example, if we're sampling accounts receivable, the sample would consist of individual account balances and external confirmations like asking customers to directly verify their outstanding balance with the company could then be used to determine the audited correct values for those selected items.
Okay, select the sample, check the items. Step 6.
Step 6 is to 6. Evaluate the sample results. This is where the numbers come alive, and the auditor interprets what the sample is telling them about the whole population.
The projection part again?
Yes. The auditor projects the misstatements found within the sample back to the entire population. Use one of the methods we discussed earlier, MPU ratio or difference estimation. This projection gives them a point estimate of what they believe the true balance of the account is. But as we said, that's not enough on its own.
Need that precision interval thing.
Exactly. The auditor then adds an allowance for sampling risk, sometimes referred to as a precision interval, to that point estimate. This allowance accounts for the inherent uncertainty that comes from only looking at a sample rather than the entire population. It creates a range around the point estimate, and the auditor aims for the recorded balance to fall within this acceptable range.
This is fantastic. A real-world example will make it so clear. Let's apply this. Say we have a population of 5,000 accounts with a total recorded book value of $4,500,000. The auditor selects a sample of 200 accounts, which collectively have a recorded book value of $184,200. After auditing these 200 accounts, say, through confirmations, their correct audited value is determined to be $175,000. The average audited value per account in the sample is $875. $175,000 divided by 200 accounts. Now, how do we get the point estimate using each of the 3 methods you described, mean per unit, ratio, and difference?
Excellent. Let's break it down using those exact numbers. For mean per unit estimation, MPU, we use the average audited value from our sample, $875, and simply multiply it by the total number of accounts in the entire population, 5,000.
Okay, 875 times 5,000.
Right. That calculation gives us a $4,375,000 point estimate.
$4,375,000. Okay.
Next, for ratio estimation, we take the ratio of the audited value of our sample, $175,000, to the book value of our sample, $184,200. And then we multiply that ratio by the total book value of the entire population, $4,500,000.
So $175,000, $184,200 times $4.5 million.
Exactly. Performing that calculation, we arrive at a $4,275,244 point estimate. slightly different.
Yeah, lower. Okay.
Finally, for difference estimation, we first find the total difference between the book and audited value specifically within our sample. So $184,200 sample book value minus $175,000 sample audited value gives us a total difference or error of $9,200 found in the sample.
Okay, $9,200 error in the sample.
Then we calculate the average difference per unit in the sample. $9,200 divided by 200 accounts equals an average difference of $46 per account.
$46 average error.
Right. We then project this average difference to the entire population. $46 multiplied by 5,000 total accounts, which gives us a projected error for the population of $230,000.
Okay, project the average difference out.
To get the point estimate, we subtract this total projected error from the total book value of the population. $4,500,000 minus $230,000. Which results in a $4,270,000 point estimate.
Well, that's incredibly specific, and it's fascinating how each method, using the same underlying data, gives a slightly different estimate. 4.375 ASIN, 4.275 ASINs, 4.275 ASINs. This really highlights why understanding the nuances and context for each method is so important, and why an auditor needs to choose the right tool based on the characteristics of the data and the expected types of errors.
Absolutely. The choice of method impacts the precision and efficiency of the estimate.
So what's the next step after getting these point estimates?
After completing the evaluation, the seventh step is to 7. Form conclusions about the balances or transactions tested. The critical decision here is whether to accept the client's recorded book value for the account.
Comparing the book value to the estimate plus minus the precision.
Exactly. The auditor determines if the recorded book value falls within the acceptable range, which is defined as their calculated point estimate plus or minus that allowance for sampling risk. If the recorded book value does fall within that acceptable range, then the auditor concludes that the book value is fairly stated and does not contain a material misstatement.
What happens if an item they selected just can't be found, like a lost invoice or something?
That's a critical aspect here, how to handle lost or unlocatable items. If, after careful consideration, treating these missing items as if they were entirely misstated wouldn't change the auditor's overall evaluation.
Meaning the total projected error would still be okay.
Right. If it would still be within tolerable limits, even counting the lost item as a full error, then further examination isn't necessary for those specific items. However, if considering them to be misstated would lead to the conclusion that the balance contains a material misstatement.
If it pushes the error over the limit.
Then the auditor must perform alternative procedures to gain sufficient evidence about those items. They can't just ignore them.
Oh, yeah.
This ensures that a lack of information doesn't lead to an incorrect conclusion.
Makes sense.
Ideally, if the sample drawn is truly representative of the population, the auditor will generally make a correct decision. But, and this is the inherent risk of sampling we keep mentioning, if the sample is not truly representative.
They could get it wrong?
Yes, they risk making an incorrect decision.
Aye.
Either incorrectly accepting a balance that is materially misstated, the risk of incorrect acceptance, or, conversely, incorrectly rejecting a balance that is actually fairly stated, the risk of incorrect rejection. This raises an important question again. How confident are you in your sample's ability to faithfully represent the whole?
And the final step.
Got to be documentation, right?
You nailed it. The 8th and final step, as with all audit procedures, is to 8. Document the sampling procedure. Thorough documentation is non-negotiable and absolutely critical.
Audit trail.
Exactly. Auditors must meticulously document every single step of the audit sampling process. This includes the initial planning, the rationale behind the chosen parameters and methods, the actual performance of the procedures, the observed results, and finally, the comprehensive evaluation and interpretation of those results. This ensures transparency, accountability, and allows for a review.
So that was a really thorough dive into classical variable sampling. But your sources also mention another significant type, probability proportional to size, or PPS, sampling. What's distinct about this method, and how does it differ from the variable sampling approaches we just covered?
Right, PPS sampling. It's quite unique and operates on a different fundamental principle compared to the classical variables methods. The key distinction is how it defines the sampling unit.
In PPS, the sampling unit is defined as an individual dollar within a population.
An individual dollar, not an account or an invoice. That sounds incredibly abstract. How does that even work in practice?
It definitely sounds abstract, but it's very effective. Once a specific dollar is selected from the population, the entire account or logical unit containing that dollar is then identified and subsequently audited.
Okay, so you pick a dollar, audit the whole account it belongs to. What kind of conclusion does it allow auditors to draw?
Well, PPS is considered a hybrid method precisely because of this unique approach. It borrows from attribute sampling theory.
Which is usually for yes-no things like control failures.
Exactly. Attribute sampling is typically used for things like testing internal controls, where you're looking at a rate of occurrence, how many times a control failed, for example. However, PPS cleverly adapts that theory to express a conclusion in dollar amounts rather than just a rate of error or a percentage of defective items.
Ah, so it uses attribute theory math because of a dollar conclusion. Clever.
It is a very clever blend of statistical approaches.
Does it have advantages?
Yes, PPS sampling also comes with some notable advantages for auditors. First, it automatically emphasizes larger items.
How so?
Because each dollar has an equal chance of being selected, larger accounts, which obviously contain more dollars, inherently have a greater probability of being included in the sample.
So it naturally focuses on the big money item.
All right. This effectively stratifies the sample without the auditor needing to perform explicit stratification steps, focusing audit effort on the areas of higher monetary risk. The chance of an item being selected is directly proportionate to its dollar amount.
That sounds efficient. Any other advantages?
Second, if the auditor anticipates no errors in the population, which, might be the case in well-controlled environments, PPS sampling generally requires a smaller sample size compared to classical variable sampling methods.
Smaller sample if no errors expected. Nice.
Yes, it makes it highly efficient in low-error environments, saving significant audit time and resources.
Okay, but what are the downsides? Nothing's perfect, right?
True. It's not without its drawbacks, and it's important to understand where PPS might not be the best fit. A significant disadvantage of PPS sampling is that it generally requires special design considerations for zero balances, negative balances, and understated balances.
Why is that?
The method is fundamentally built around the concept of positive, correctly stated dollar amounts. Those unusual situations where an account might be zero, negative, or even significantly understated don't fit naturally into its dollar unit selection logic.
So it struggles with zeros and negatives.
Essentially, yes. Auditors need to employ specific workarounds or separate procedures to handle these unusual balances effectively, which can add complexity.
How do auditors determine the sample size for PPS then? Is it also formula-based like classical variable sampling, but perhaps with different inputs given the dollar unit approach?
Yes, it is very much formula-based and the logic is quite distinct. The auditor selects a PPS sample by conceptually dividing the total number of dollars in the population, which is the recorded book value, into uniform groups or intervals.
Sampling intervals again.
Yes, but calculated differently. They then select one logical unit. That's the account balance that includes the selected dollar from each of these sampling intervals.
Okay, how do they calculate the interval?
The sampling interval is a key calculation in PPS. It's determined as follows. Sampling interval, tolerable misstatement reliability factor.
Okay, tolerable misstatement divided by a reliability factor. What exactly are these reliability factors? You mentioned them in the formula. Are they simply a number, or do they represent something more intuitive for our listener?
Good question. Reliability factors are critical inputs into the PPS sample size calculation. They correspond directly to the auditor's acceptable risk of incorrect acceptance.
The risk of accepting when it's wrong.
Right. And they are typically obtained from standardized statistical tables. Think of them as a statistical multiplier that scales up or down based on how much risk of being wrong the auditor is willing to take.
So lower risk means a higher factor.
Exactly. For instance, in a scenario where the auditor expects zero errors, if they set their risk of incorrect acceptance at a very low 1%, the corresponding reliability factor from the table would be 4.6. If the risk is a more moderate 5%, the factor is 3.0, and for a 10% risk, it's 2.3.
Okay, tables give you the factor based on risk.
Yes, and it's critical to note that the simple formula I just shared for the interval, and subsequently the sample size, assumes the auditor expects zero misstatement in the population.
Ah, only works if you expect no errors.
Well, the simple formula does. If errors are expected, a more complex version of the formula is required to adequately adjust the sample size and account for those anticipated errors.
Got it. So how is the actual sample size calculated then?
Once you have the sampling interval, the overall sample size is determined by sample size, recorded amount of the population sampling interval.
Okay, total book value divided by the sampling interval. Let's apply this to a real scenario to make it tangible. Say the auditor assesses tolerable misstatement at $15,000, and they've set the risk of incorrect acceptance at 5%. The total recorded amount or book value of the population they're auditing is $500,000. How many items do they actually need to sample using the PPS method?
Great question. Let's walk through it. For a 5% risk of incorrect acceptance, as we noted, the reliability factor is 3.0.
Okay. Risk is 5%, factor is 3.0.
First, we calculate the sampling interval. Sampling interval, tolerable misstatement reliability factor. Sampling interval equals $15,000. 3.0 equals $5,000.
$5,000 interval.
Now, we use that interval to determine the sample size. Sample size, recorded amount of the population sampling interval. Sample size equal $500,000, $5,000 of 100 items.
So a sample size of 100, okay.
Yes. In this specific scenario, a sample size of 100 logical units would be determined, meaning the auditor would select 100 accounts for detailed examination.
So they know they need to audit 100 accounts. How do they actually pick those 100 accounts based on this dollar unit approach? It seems less straightforward than simply picking 100 random accounts.
It's a specific, systematic process rooted in that dollar unit concept. They begin by selecting a random number between 1 and the calculated sampling interval, so 1 and 5,000 in our example, inclusive.
A random start number.
Right. This random number becomes what's called the random start, and it determines the very first item selected for the sample. From that point, systematic selection is used. They pick every nth dollar, where n is the sampling interval, $5,000 in our case.
Every 5,000th dollar, how do they track that?
To do this practically, the recorded amounts of the logical units the account balances throughout the entire population are cumulatively added, like a running total.
Okay, a cumulative list.
Yes. Individual dollars are then selected based on whether they fall into one of those systematic intervals starting from the random start. So if the random start was, say, the 300th dollar, they'd select the account containing the 300th dollar, then the account containing the $5,300, 300 plus 5,000, then the $10,300, the $15,300, and so on, throughout the cumulative listing of accounts. Once a specific dollar within an account is selected by this process, that entire account gets audited.
Got it. Systematic selection based on the interval.
Exactly. And a crucial note here, using this methodology, all account balances that are individually greater than the sampling interval, $5,000 in our example, are automatically selected for 100% examination.
Oh, because they're so big, they have to contain one of those nth dollars.
Precisely. They are guaranteed to be in the sample because their total dollar value ensures they span at least one of those $5,000 intervals.
Clever. Once the sample is selected and those 100 accounts are audited, how is the evaluation of the sample results done specifically for PPS sampling? Does it involve projecting errors in a similar way to variable sampling?
Yes, the projection of errors is central to PPS evaluation, but it handles errors slightly differently if no errors are found in the sample.
The ideal scenario.
Right. Then the projected error for the population is simply 0. In this favorable scenario, the allowance for sampling risk would not exceed the auditor's tolerable error, and the auditor would generally conclude that the recorded balance is fairly stated, requiring no adjustments.
Okay. But what if they do find errors?
If, however, errors are found in accounts selected through PPS, these errors need to be projected to the interval using what's called tainting.
Tainting? That sounds quite interesting, almost like a forensic term. What does that signify in this context?
It is an interesting term. Here's how it works. If an account that was selected has a balance greater than the sampling interval, meaning it was one of those large accounts automatically included.
The ones bigger than $5,000 in our example.
Right. The actual dollar amount of the error found in that specific account is simply used directly as its projected error. There's no further calculation for that particular item, just use the actual error found.
Okay, simple enough for the big ones. What about the smaller accounts?
But for accounts that were selected and have a recorded balance smaller than the sampling interval, we calculate a tainting percentage.
Tainting percentage? How?
This is done by dividing the error amount found by the recorded amount of that specific account. Error divided by book value for that item.
Okay, so what percentage wrong was that item?
Exactly. We then apply that tainting percentage to the sampling interval to get the projected error for that individual item within its respective interval. This essentially means we're projecting the rate of error found in that smaller account across the entire interval it represents.
Let's try to visualize this with an example. Can you imagine a table of audited items from a PPS sample using our $5,000 sampling interval from earlier and show us how that tainting calculation works?
Absolutely. Let's see it in action with a hypothetical table of results. Remember, our interval is $5,000. Imagine the first selected account had a recorded amount of $800, but when audited, it was only $600.
Okay, $200 error.
Right. The error found is $200. Since it's smaller than the $5,000 interval, we calculate the tainting. $200 error divided by $800 recorded amount equals 25%.
25% wrong.
We then apply that tainting percentage to our sampling interval.
Yeah.
25% of $5,000 equals a projected error of $12,250 for that interval.
Okay, project the 25% across the five-tail interval. Got it.
Now, a second account might have a recorded amount of $4,350 and was audited for $4,350. The error is $0.
No error, no tainting.
Correct. The tainting is 0%, so the projected error for that interval is $0. Consider a third account with a recorded amount of $4,900 that when audited was found to be $0, meaning it was entirely misstated.
Or completely wrong.
Yes. The error is $4,900. The tainting is $4,900 divided by $4,900, which is 100%. So the projected error for that interval is 100% of $5,000, equaling $5,000.
Okay, 100% tainting projects to the full interval amount.
Right. Now, here's an example of an account larger than the interval. A fourth account had a recorded amount of $8,500 and was audited for $6,900.
Bigger than the 5K interval. Error is $1,600.
Correct. Since this account's recorded amount, $8,500, is larger than the $5,000 sampling interval, we don't calculate tainting. Instead, the actual dollar amount of the error, $1,600, is used directly as its projected error.
Just use the $1,600 error itself.
Yes. And finally, let's say a fifth account with a recorded amount of $1,500, audited at $1,200. The error is $300.
Smaller than the interval, tainting needed.
Right. The tainting is $300 error divided by $1,500 recorded amount, or 20%. So the projected error for this interval is 20% of $5,000, which is $1,000.
Okay, 20% of 5K is $1,000.
So adding these up, the total projected error from these specific items in our sample would be $12,050 from account 1, plus $0 from account 2, plus $5,000 from account 3, plus $1,600 from account 4, plus $1,000 from account 5.
Which adds up to?
Which sums to a total projected error of $8,850.
So you sum all those individual projected errors, whether they came from a tainting calculation or a direct error amount from a large item. It's truly fascinating how this method extrapolates findings from individual dollars across the entire population.
Exactly. You aggregate all those individual projected errors. And just like with other variables, sampling plans, an allowance for sampling risk would then be calculated and added to this total projected error.
Add the buffer for uncertainty.
Right. This final figure, the total projected error plus the allowance for sampling risk, is then compared with the tolerable misstatement that the auditor set at the planning stage, $15,000 in our example, to form the final conclusion about the fairness of the recorded balance.
We've talked a lot about the numbers and calculations, the mechanics of sampling, but auditing can't just be about crunching figures, right? What other more qualitative aspects do auditors consider when they find deviations or misstatements during their sampling procedures? Can you paint a picture for us? What's the very first thought or action an auditor takes if they suspect a deviation is actually fraud versus just an error?
This raises an important question, and it's a critical area where human judgment truly shines. For all types of sampling, whether it's variable sampling or PPS, the qualitative aspects of deviations and misstatements are incredibly important, often as much as, if not more than, the quantitative amount.
It's not just the number, but the why.
Precisely. It's not just that an error occurred, but why it occurred and what that occurrence truly signifies. Firstly, the nature and cause of deviations are paramount. An auditor needs to discern whether the deviations are due to errors, which are, unintentional mistakes or omissions.
Honest mistakes.
Right. Or whether they stem from fraud, which involves intentional misrepresentation or manipulation.
Intentional, that's the key difference.
Absolutely. The intent behind the misstatement makes a fundamental and hugely significant difference in how the auditor responds. An accidental data entry error is treated very differently from a deliberate attempt to inflate revenues.
So what happens if they suspect fraud?
If fraud is suspected, the auditor immediately escalates this. It's a whole different ballgame. It impacts trust, potentially points to collusion, and it changes the entire risk assessment for the audit. It requires a completely different investigative mindset and usually involves bringing in specialists.
Okay, what else qualitatively?
Secondly, auditors consider the possible relationship of deviations to other audit phases. Discovering fraud, for example, typically triggers a much broader and deeper consideration of its potential implications across other areas of the audit.
The ripple effect.
Exactly, far more so than discovering an unintentional error. Fraud points to a more systemic, perhaps deliberate issue that could permeate various financial statements and internal controls, indicating a breakdown of trust and integrity.
So they have to look wider if fraud is suspected.
Definitely. It demands a significant reevaluation of audit risk and often requires expanding the scope of procedures to other related accounts or periods. An unintentional error, while still requiring correction and follow-up, doesn't usually escalate the audit to the same level of concern or require as extensive a reassessment. It's about understanding that ripple effect, yes.
Auditors are always looking for efficiency in their work. Are there times they can combine different types of tests, perhaps looking for both control failures and monetary errors with the same sample? Killed two birds with one stone, so to speak?
Yes, absolutely. In some instances, an auditor might use the very same sample to perform both tests of controls, which assess the effectiveness of a client's internal controls.
Checking if the process works.
Right. And tests of details, which are substantive tests of monetary amounts, like checking account balances.
Checking the actual numbers.
Yes, these are known as dual-purpose samples. It's a way to gain efficiency by leveraging a single set of selected items for multiple audit objectives.
When would this be an appropriate or advisable strategy for an auditor? It sounds like you'd need to be pretty confident in the underlying controls to begin with.
You're exactly right. Dual-purpose samples are generally only used when the auditor believes there's an acceptably low risk that the deviation rate in the population, that is, the rate at which internal controls are failing, exceeds the tolerable rate for those control failures.
So only if they think controls are probably working okay.
Basically, yes. They need to be reasonably confident that the controls are working well enough that this combined approach won't miss anything critical in terms of control breakdowns. If the controls are weak, a dual-purpose sample might not provide sufficient assurance for the control test objective.
Do they use a smaller sample size then, since it's dual purpose?
No, actually the opposite. When designing such a sample, its size must be the larger of the samples that would have been designed for the two separate purposes.
Oh, the larger size.
You don't cut corners on sample size just because you're combining tests. The sample must be robust enough to satisfy the requirements of both the control test and the substantive test independently. So you take whichever one would have needed the bigger sample.
Got it. And how do they evaluate the results from a dual-purpose sample? Does a monetary misstatement automatically mean a control failure, or vice versa?
That's a crucial distinction. When evaluating dual-purpose samples, deviations from controls and monetary misstatements must be evaluated separately, using their appropriate risk levels and tolerable rates.
Evaluate them independently.
Yes. While the existence of monetary misstatements might indeed indicate a control failure, for example, an error in recording a transaction could point to a faulty control over accuracy. It's crucial to remember that the absence of monetary misstatements does not necessarily imply that controls are operating effectively.
Really? No money error doesn't mean the control worked.
Correct. A control could fail without immediately resulting in a financial misstatement. Perhaps the control failure was caught by another subsequent control, or the specific circumstances just didn't lead to a financial error in that particular instance. It's a subtle but profoundly important distinction for auditors. The financial outcome doesn't always perfectly reflect the operational effectiveness of the controls themselves.
In today's rapidly evolving world of massive data sets and advanced technology, how do modern tools like audit data analytics, or ADAs, fit into all this sampling and audit work? Are they replacing sampling or enhancing it?
That's a great question. This is a rapidly evolving and incredibly exciting area in auditing. ADAs are definitely enhancing the process.
How so?
When an auditor uses an ADA technique for tests of details, they must first meticulously select the ADA technique that best fits the intended purpose and objectives of the specific audit procedure. It's not one size fits all.
Choose the right tool for the job.
Exactly. This involves choosing the right analytical methods, maybe visual aids like charts and graphs, and data tables to effectively evaluate the results of the analysis. It's about leveraging technology to process vast amounts of data quickly and find patterns or anomalies.
So what happens after the ADA runs?
After performing the ADA procedure, the auditor should strategically group the data for items that share common characteristics. This helps in organizing and analyzing the output from the ADA. For each of these groups, they then determine which data do not contain misstatements. These are sometimes referred to as false positives, meaning the analytical tool might have flagged them as unusual based on some criteria, but upon closer inspection, they are actually fine.
Okay, filter out the false alarms.
Right. Then they look for data that contain possible misstatements that are clearly inconsequential when considered together in aggregate. These are minor, immaterial errors that don't really warrant further investigation on their own.
Small stuff.
Yes. And finally, the important group contain possible misstatements that are not clearly inconsequential when aggregated. These are the items that genuinely represent areas of concern and require deeper scrutiny.
So ADAs help them quickly sort through large amounts of data to find the potentially problematic areas, essentially narrowing down what the human auditor needs to focus on.
Precisely. That's a great way to put it. For those groups containing possible misstatements that are not clearly inconsequential, the auditor then performs further, more focused analysis. This could involve traditional sampling techniques on that specific subset or other detailed substantive procedures to confirm whether these items genuinely represent actual misstatements.
So ADA points the way, then maybe sampling confirms it.
Often, yes. ADAs significantly enhance the auditor's ability to sift through vast data sets, quickly identify patterns, anomalies, and potential risks, and pinpoint specific areas requiring human judgment and deeper investigation. They don't replace judgment or sampling entirely, but they make the process of identifying where to apply those skills vastly more efficient and targeted, allowing auditors to focus on the truly critical areas.
Wow, what an incredible deep dive into audit sampling. From variable sampling, estimating those precise dollar values, to probability proportional to size, focusing on individual dollars, and then layering on the crucial qualitative aspects, dual-purpose samples, and the transformative role of audit data analytics. It's clearly a rigorous, methodical, and increasingly technologically advanced approach to ensuring financial accuracy and reliability.
Indeed. Understanding these intricate methods truly reveals the meticulous effort and thoughtful design that auditors put into providing assurance about financial statements. It's a complex yet elegant blend of statistical precision, the judicious application of sampling theory, and ultimately, as we've discussed, informed professional judgment. It underpins much of the trust we place in financial reporting.
It truly is. So what does this all mean for you, our listener? It means that behind every financial report, every balance sheet, and every income statement you encounter, there's a complex, thoughtful process at work. It's a hidden world of statistical analysis and careful judgment, all aimed at giving you confidence in the numbers presented. The next time you see a financial statement or hear about an audit, perhaps you'll appreciate the meticulous, intelligent, and sometimes surprising world of sampling that went into ensuring its accuracy. Thank you for joining us on this deep dive.
Keep exploring, keep questioning, and stay curious. You might just uncover more layers of insight than you ever expected in the numbers around you.